I'm Nikki Sedlow, the event manager at Venture Cafe St. Louis, and I'm glad to have you all here to learn about how Midwest startups can raise venture capital in Canada from our speaker, George Khalife, the Vice President of Capital Formation at the Toronto Stock Exchange. Venture Cafe St. Louis hosts one of the largest in-person weekly events for entrepreneurially minded people, and now we're hosting talks with experts throughout the week to help you launch and grow your business or idea. George Khalife is a sales and marketing professional with a background in finance and the DNA of an entrepreneur. George is based out of Chicago, and he helps U.S. companies across the Midwest raise public capital in Canada. On the side, George has co-founded an app called Book Back for students to buy and sell books more easily, which cracked the top 100 list for book-related apps, as well as hosts a podcast called Let's Grab Coffee, where he interviews successful leaders across different industries. We're excited to have him here with us today. Thanks so much, George, and I'll let you take it from here.
Yeah, thanks so much for having me and for the entire Venture Cafe team. It's definitely a pleasure to collaborate, and obviously look forward to hopefully more down the road. First and foremost, also just want to thank everybody who is either dialed in or eventually will watch this recording. I hope you're all keeping safe, healthy. I think that's the most important part. So yeah, just thoughts go out to everyone on the call. So as mentioned, if you kind of look at what we've been doing, I mean, I just moved to Chicago, and it's been about 6 or 7 months now actually in market. And really my role, as mentioned, is really to work with companies, especially in the US, across the Midwest. And for us, Midwest are regions like obviously Illinois, Michigan, Ohio, Wisconsin, Minnesota, pretty much everything kind of between the coasts. Let's put it that way, between Seattle, New York, Boston. Everything in the middle is really what we're trying to cover as part of the Midwest, and really working with founders, CEOs to help them learn about access and ideally raise capital in Canada. So it's a bit of a different kind of market. It's a bit of a different situation up north than it is in the US. And that's kind of what we'll start talking about, is what are those different dynamics that we see in Canada versus the US. We'll talk about when could it be a right fit for certain companies. But ultimately, the one thing I just want, especially for founders on the call, at whatever life cycle or whatever stage you're at, especially in your venture or your startup, really, I think that the best thing that you can get from listening to this is just to consider this type of option on the menu list of financing options that you have in front of you. It's always good to get educated, and especially speaking to or on a couple of webinars, that's kind of been my advice. A lot of the founders is use this time, especially now that we're kind of coming out of the pandemic, hopefully, and things start settling down, is just educate yourself on different options and really understand the pros and cons of each option and figure out which one makes the most sense. And so, I mean, this is kind of why the title of this workshop is From Idea to IPO, and really looking at these different segments. So if you look at kind of the trajectory, right, of raising capital, I'm sure at some points, people listening, you'll recognize a lot of these sources of capital, especially the more traditional ones, like the angel rounds, the VCs, the Ps of the world. And we'll talk a bit more of how these quote unquote non-traditional sources fit into this whole, North American equity capital landscape. But typically, if you look at the different stages, right, any startup, any company that goes through these will typically hit on each category. So obviously, when you're in that project idea stage, you're typically either funding it yourself, so you're bootstrapping it, or you raise a small friends and family round, right? Nothing shocking there. Typically, when you go into that R&D and prototype stage, you're raising an angel round, right? And this is either from high net worth individuals who lead the full round. And, I think rounds in this case typically look like anywhere from 50,000 to 500,000 plus is typically what an earlier stage seed round from angel investors would look like. Or it could be even angel groups, right? Like the Keiretsu Forums of the world and other kind of local angel investment groups. Once you pass towards the commercialization, and it's not always tried and true. I mean, some VCs operate in the R&D prototype stage, but for the most part, if you're looking to raise that kind of traditional VC round, especially when you hit to the Series A plus or Series B, they're typically looking at companies who have commercialized their product. They've gained some traction in terms of either customers, users, depending on obviously what you offer, but that's kind of where they come in. We see private equity typically in the later stages. It's not surprising there. They'll typically come in when the company has stable production. They've not only gained traction, but they're kind of on that growth trajectory. especially private equity firms who really delve into the tech space. Obviously, equity crowdfunding is, I think, a legitimate, capital source, especially in North America, right? I mean, I was just talking to a company yesterday who was actually in market and crowdsourced, I believe, around 50 to 60,000. So it's definitely a venue for some companies. The only thing I would mention with crowdfunding is it can sometimes, crowd the cap table. So I think that's the only thing that I would be a bit more cognizant of, is how that's going to look like for later rounds, especially when you go towards things like an M&A, or you want to raise maybe a larger Series B round with a notable VC. They might just be a bit hesitant in terms of, a very crowded cap table with, with a lot of smaller investors. So just be cognizant of that. But nonetheless, I think it could be a good source. And then when you look at the public markets, this is kind of what I wanted to talk about, obviously, for this workshop, and just showcase the difference between, the realities of the Canadian market versus the US market. And so we'll talk a bit more about those two-tiered markets, but generally speaking, we have the TSX Venture, which is really tailored for, earlier stage companies. So these are companies that typically raise anywhere between 2 to 20 million, right? So no different than, I would say, an early seed to kind of a late stage venture round. And just so you know, this is public capital. The TSX Venture uses technology from the Toronto Stock Exchange. So, it's definitely a great platform. The only difference is really it's tailored for earlier stage companies, from the listing requirements to what companies have to do to maintain their listing on the public markets. It's really focused on that earlier segment. And we have about 1,700 companies right now that are listed, 3,200 across both exchanges. Then when you look at the TSX, some of you may know, right? It's a major Canadian exchange. It's actually one of the third largest exchanges in the world, comparable to NASDAQ or the New York Stock Exchange. I would say the only difference is both the size of companies that we typically see go public, but also the raises that they're actually doing on their IPO. And typically the TSX, in terms of that life cycle, you'll see more, obviously, as I said, later stage companies, more established businesses. They're in that stable production. They have operating history to validate that as well. And so that just kind of gives you a bit of a glimpse as to where public capital fits versus the private side. So I'm not sure if some of you have read the recent NVCA report. I found it super interesting, and for anyone interested, I can also provide the link afterwards. But just, I guess, to summarize it for your convenience, some of the things that really resonated is, if you look in just in 2019, so US VC-backed companies raised roughly 133 billion, but VC funds themselves raised 50 billion. So that kind of tells you that a very large chunk was raised from, I would say, non-traditional sources, and around 63% of that came from non-traditional VC. So whether that was private equity, asset managers, corporate groups, you're seeing a bit of a trend here, which is good, right? I think it's good that founders have different pockets of capital that they can access. I think what you're also seeing, especially now, kind of with the whole pandemic and what's going on, in terms of a dry powder that VCs have, which is the amount of capital that they have to invest in either new companies or their existing portfolio companies. They have about 120 billion in dry powder. And so, although that actually is at record highs, it might not actually sustain the pace of investing that they've been doing. So needless to say, I think it's a good segment in terms of founders just exploring different options. And this is really good data to support that. So going public in the States, as I'm sure, again, a lot of you probably know, is typically at a much later stage, right? Like if you look at just the median IPO raise across the US, it's typically around 240 million. And I did some research, and this is via PitchBook if you want to know the source. But I just wanted to look at the past 10 years, strictly in Chicago, looking at notable exits via IPO. Okay, and what you typically will see is there were around 20 companies that exited via IPO past 10 years. And if you look at the numbers, the average IPO raise just in this city was about 150 million. And on average, companies had $1 billion plus in revenue. So right off the bat, you can really kind of summarize, if you want to be a bit generic, and say that to go public in the States, you typically have to be a much later stage company. And that's only just to make sense of, the cost of going public, but also to maximize the value of doing so. So going public in Canada is a bit of a different kind of mix. And I think that's that's something interesting as you think of going from idea to IPO, that going public in Canada could actually be suitable for earlier stage companies. We talked about, when you looked at that kind of life cycle chart in the first slide, we talked about that two-tiered market. So again, the TSX Venture Exchange, I think just looking at this slide, what I want to highlight is what those numbers look like. And you can kind of see the difference and contrast and compare versus what the US looks like. So just on the TSX Venture Exchange, as I said, the typical financing is anywhere between 2 to 20 million. That's what companies are raising as a range. But the average is really 3 or 4 million. And that was as of last year. So that's current, right? And 3 or 4 million is really not that large. In fact, we see some companies raise sometimes 500K. And we'll talk a bit more about kind of what that process looks like. So, and just to give you kind of a gist of what those market values look like, it's typically less than 75 million. So that's on the Venture Exchange, the platform suited for earlier stage companies. In terms of the TSX, that's where companies can raise anywhere between 20 to 100 million plus, as we said, and you know, obviously much larger companies. So this is kind of just the inverse, if you want to make it easier for you to remember, is you have these two-tiered market. One platform is suited for later stage exchange companies, and then the venture is really where I think we can focus our efforts on, at least for today. So I always use an analogy, and I don't know if some of you watched the Last Dance, but obviously huge basketball fan, and I think it was an awesome documentary. But this is kind of the analogy I always use to explain why we have this set up. And if you're a company thinking about public capital and why that makes sense, but maybe we're too earlier stage. I think one of the key reasons we have this kind of two-tiered setup is you have the venture exchange, the TSX model, right? So you have the ability to really use the venture as kind of the incubation model for earlier stage companies to not only raise public capital, but get comfortable being a public entity. Too many times, like, you guys have to wait so long to get to a point where you're more situated to go through this route. But the venture exchange gives you that at an earlier stage and a possibility to actually raise public capital. But what's even more interesting is we've seen almost 680 companies graduate, so go from the venture exchange to the TSX, or what we call kind of uplisting. And that's my analogy in terms of going from the NCAA to the NBA. So think of, a college athlete going from college basketball to the big leagues, right? So that's why it's super interesting. And you'll be surprised how many companies actually go through that route. Some of the companies are noted below, like Canopy Growth, which became one of the largest cannabis companies, the first, I believe, to list, Aura, the Stars Group, which is more so on the gaming / poker space. Patriot One, more on the tech side, just gives you a bit of a glimpse as to what that looks like. And again, for US companies, obviously being in Chicago, being in the Midwest, we've talked to a lot of US CEOs and founders who really have their eyes set on a major US exchange, right? Like a New York Stock Exchange or a NASDAQ, and that's totally fine. In fact, you can actually use your listing on the TSX or the venture as a stepping stone into the US market. So we've seen almost 190 companies do that. And why that's interesting is sometimes it's more facilitated, right? So you get certain exemptions, like, for example, there's really a rule called MJDS, which is a multi-jurisdictional disclosure system. And it basically says that, to substantially satisfy their US reporting obligations, they can use their Canadian disclosure documents. And typically from a regulatory standpoint, being a Canadian issuer can be a bit more of a facilitating process versus in the US. So that's I think one of the coolest parts about it, and I'll show you in a bit just kind of a case study of a company that's actually done those three parts. In terms of process, and I'm sure a lot of you are wondering, I think this is important to talk about, especially because I think that a lot of startups are more familiar with raising private capital in terms of the VCs or the Ps of the world. I think typically you're more familiar with that process versus public capital in nature, and that's kind of part of why we're in the US is really to help facilitate that. So just to kind of talk about different processes that we typically see. So obviously off the top of the bat, you have the traditional IPO, which a lot of you already know. I mean, this is what you typically see, where you file a prospectus, you have involvement from investment bankers, and we typically see this process more so for the TSX, but also in some cases for larger size TSX venture companies that list on the venture exchange. In terms of what, if you just want to focus on the TSXV, what the most common, most successful way to go public, it's actually not through an IPO. And that's probably something that's, I would say, a bit more kind of surprising to a lot of the founders who might not know about a different process to go public. In fact, one of the most common, most successful ways to do so is through what we call a capital pool company. So a capital pool company, very simply, is typically a minimum of 3 directors, officers. So these are individuals who have public market experience, serial entrepreneurs, could be high net worth individuals. They get together and form a shell. So this shell has no operations. All it has is cash on the balance sheet. They end up taking this shell public. So it's a publicly listed shell, but again, I mean, it's clean. There's nothing in it other than cash. And that cash is basically used to find a private company within a period of time to help take public. So what ends up happening is you have the shell that's already public, it's publicly listed, you have a private company, and through a process called a reverse takeover, which you see in that second bucket, the private company vends into the shell through what we call a qualifying transaction. The reason why that's so common, probably the most successful way to go public on the venture exchange is, if you're an earlier stage company, let's say, and I'll give you an example of what that means. Let's say you're doing $2 to $5 million in revenue. You're a tech company, you have about 15 people, you have a seasoned board, a good product, and you're looking to raise public capital. In many cases, this is a more streamlined way to go public because now you're just using this as a vehicle to become a publicly listed entity. And from there, you can do subsequent rounds of financings. You can use shares as a currency to make acquisitions. And we'll sort of talk about why public capital versus private. But just to give you a quick glimpse, and on top of that, I think one of the key reasons is those 3 directors or officers that formally created that shell to begin with, they serve as advisors on the public markets, especially for a lot of CEOs, typically of US companies who don't have Canadian public market experience. They can be a great segue to that. So let's kind of spend some time just talking about the going public considerations. What do those look like? Questions around when would a company be a good fit? When would a company start thinking about something like this? I think those are really important questions, and we'll spend some time just talking about that. So in terms of the reason, I think that's super important just to start, right? And obviously we can help lay them out, but does your company have a really good reason to be public? And I think why that's a good starting point is if you talk to any of the investment banks, any of the local deal makers, that's typically a question they want to find out. And I'll be very direct. I think the reason is what they don't want is a situation where a US company looks to raise public capital up north because they're unable to do so in the US, right? So I think that's a situation where understandably, is not necessarily desirable, but some really good reasons to want to go public and raise public capital is obviously access to growth capital, right? And when we say capital, I think the important thing to really parse out here is non-dilutive capital, especially in, a model like the CPC, for instance, where you go public through the reverse takeover model. Typically we see, founders still hold majority of the company. I mean, obviously founders and investors, if they're included, but they'll typically hold about 60, 65, or 70% of the company. The original CPC founders will typically hold anywhere between 3 to 10% at most, and then the rest is publicly floated, just to give you an idea. And obviously using that acquisition currency. So acquisition currency, just to spell it out, is basically your ability to use shares to make acquisitions versus cash, which is obviously tax efficient, cost effective. And other things are credibility, exposure, even in an earlier stage, right? I mean, you're able to use the fact that you're public as a way to show that you're more transparent, your ability to sell to larger clients that are already public, right? It gives you a bit of that segue up. And then you can have stock incentives for employees through things like employee share purchase plan. And lastly, it could be liquidity for a lot of the shareholders, right? Let's say you raise an early seed, a late stage Series A. Eventually, that can be a way out for early stage shareholders who want that liquidity option. Are you ready? But I think that this is obviously a very important consideration. And as I said in the beginning, and the reason why I wanted to mention that in the beginning is typically, companies we talk to are never ready day one. So don't feel discouraged if this might seem overwhelming or you think you're way off the trajectory. It's always actually better to learn about this way earlier in terms of your life cycle, build the right relationships, figure out what milestones you have to kind of tick off before you get this process going. So things like, do we have the right management team in place? Do we have a right CFO, just as an example? Do we have a board of directors, like a formal board of directors? And we typically require 2 independent directors on the board. Have we audited our financials? For a lot of the companies who have raised money, especially kind of closer to kicking off a go public process, this would already be a given, so that's fine. And then in terms of the CEO position, are they well suited to do things like investor relations, right? Can you sell the vision? Can you communicate it clearly, etc. So meeting the exchange and listing requirements is obviously a super important part of the process. So we just have I actually have a link to the guide of listings here. Just kind of goes through, I would say, a couple of categories that we look at. Some things are revenue, working capital. So basically, to summarize, there are financial requirements, not ones that are too stringent, I would say, but ones that obviously we want to kind of tick off. So to give you an example, on each exchange, we have different tiers. And basically, each tier pertains to more so the size of company that is looking to list, essentially. And with each tier comes different requirements. And obviously, there are different requirements for different sectors. So the best thing is just to check that out and see specifically what we look for in terms of the history of operations, the management board of directors, and as I said, on the financial side, revenues, working capital. And we can talk a bit more about that in the Q&A in terms of how early of revenues would you have to have in terms of even considering this process to begin with. And finally, in terms of that last R, and we call these the 4 Rs, but is really, can you get investment banker support? I think that's super important for any company considering the go public path. This is no different than raising private capital, by the way. Think of, when you're raising a VC round, you're really trying to sell not only the company, the idea, but also the management team, and you're trying to garner support. You're trying to gauge interest, right? Is there traction for our company? And it's not very different, I would say, on the public markets. In this case, it's just a different audience. It's typically investment bankers or capital pool founders, as we talked about. And so, can you get support essentially for your type and size of company in this market condition? And sometimes it could be difficult, right? During those peak COVID months, depending on what vertical you're in and what business you're in and how sensitive your revenues were towards what was happening. Let's say you were in the hospitality space, it was hit pretty hard because of COVID. Is this the right time to launch this process during this market condition? Just to give you an idea. And then some relevant case studies before we do go into, I'm just checking the time, before we do go into to some Q&A. So this is a super interesting story, which is VIEMED Healthcare. And obviously I like to highlight this because I know, quote unquote, it might not be Midwest Great Lakes. So I'm a newcomer to the States. So it's okay if you give me a bit of grace, but they're based in Lafayette, Louisiana. So as I said, between the coasts is probably a better definition. But what's interesting about VIEMED, especially obviously in this time, is they're a provider of equipment and home therapy to patients with respiratory diseases. So things like oxygen problems, sleep apnea. And I think most of their services is towards neuromuscular patients. One of the key things I want to point out is, if you recall from when we first started the presentation, we talked about that 2-tiered model, right? The venture and the TSX and the ability of companies to graduate. So VIEMED went public on the TSX venture in 2017. Okay, so earlier stage company goes public, leverages public markets. They then uplisted to the TSX in 2018. And then here on the graph, you can see in this, I don't know if you can see my cursor, but you can see that box kind of pointing to when they actually dual listed on NASDAQ, right? A major US exchange. So here you have really obviously a growth story, but a story in the US, kind of Midwest, showing those 3 pieces of growth categories, starting on the venture, uplisting to the TSX, and dual listing on a US exchange. So that's kind of what I really wanted to highlight. Obviously, there are some other growth cases. Maybe this one we can point out, which is, I think some people on the call would appreciate, but it's called Enthusiast Gaming. So they're the fastest growing online community of video games. or video gamers, I should say. But this is another cool example of how public markets are a bit different than private, in the sense that in every emerging space, right? Think like e-gaming, blockchain, whether it was cannabis, now telehealth or digital health. Capital markets are typically one of the first, I would say, investors in growing sectors, right? Like the ones I just highlighted. And they're typically the first to deploy that risk capital in these kinds of verticals. So what's super interesting is here you have a company, you know, especially in the e-gaming space, they go public in 2018 through that qualifying transaction. So Enthusiast Gaming went public through the capital pool program that we talked about on the venture exchange. They've raised 34 million to date, a market cap of about 150 million. They're doing 13 million in revenue. So again, just to give you a snapshot, it's not too far-fetched from where I'm sure a lot of founders listening on the call are. And then just the last thing I'll highlight in this use case is, as you can see, I mean, they've done, I think it's 3 financing so far. So they've used their listing to do different rounds of financings. And then they've done, I believe it's 4 acquisitions since they've been public, again, using that share currency. So this displays all the things we've kind of talked about in a nutshell, but actually gives you a real use case. So that's kind of it in a nutshell. I know, you know, it's obviously a lot to digest, a lot of content, but at least it gives you a bit of a high lens overview of what we're trying to do and some of the case studies of companies that have actually leveraged public markets. And this is my favorite part. Obviously, I want this to be engaging. So ask away anything. There are no stupid questions. All of them are smart. And so I'd love to answer any of them.